A very good evening to all our viewers. You've tuned in live to Money Control, and this is Earnings Express with me, Stacey Pereira, and we are here to break down crucial numbers that have just come out by IT firm Wipro. Now, let's break down those numbers for you and give you an overview where we have the revenues that have declined nearly 3% in quarter one. If you look at the constant currency term, the company's guidance too, that is projected quite tepid for Q2 in terms of their revenue growth. And if you look at the constant currency IT services revenue, they've given a guidance of -2% to +1%. This is a little bit better than what they were projecting for this one, which was -3 to -1. Now they're changing that to -2 to +1. You can say somewhat being cautious, you could say, because they're also warning that there could be another contraction. So let's look at each of those numbers then. Revenues have come in at 22,755 crore rupees. This versus 23,176 crore rupees on a quarter-on-quarter basis, means that it's down 1.8%. If you look at the EBIT number, operating profits, that is down about 3%, coming in at 3,652 crores versus the 3,776 crores it saw in quarter four. If you look at the margins, now that number has come, you could give it a little bit, look at it in some respite, because it's coming at 16.05 versus 16.25 that was reported last quarter, but the estimates were that of just 16%. So pretty much in line numbers in all of those counts. Attrition, if you look at that, has come in quite surprisingly at an 8-quarter low. So something to cheer about at 14%. But let me warn you, there is also a huge headcount reduction. So all in all, we could say some hits, some misses, but pretty much in line. That was a snapshot of these numbers, but let's discuss them further and what they really mean for the company, what was expected, and have they really delivered that. And to do that, joining me are my guests, Gaurang Shah, the Senior Vice President at Ageo Financial Services, as well as Nirav Karkera, the Head of Research at FISDM. Thank you, gentlemen, for giving us your time and hopefully helping our viewers understand what these numbers means. Let's take each one of them and break it down. First of all, the guidance, because we already had TCS as well as HCL Tech that came out yesterday. While HCL has maintained the guidance that they had projected, we have some little bit of change coming in here from Wipro, but TCS anyways doesn't give us that number to look forward to. But what is it really telling? Is the company still cautious? Are those IT spends a worry for them? Gaurang, how are you looking at these numbers?
Thank you, Stacey, for having me on this show, and good evening to all of you. Also, in terms of performance, stock-specific Wipro, even if you see the past earnings as well as the stock price performance, it has been rather disappointing, and it has been one of the laggards. I hope I have the liberty to say that. Not only in terms of price performance, but also on the earnings front. And this is no surprise. First, a disclosure, because we have a fundamental buy call on Wipro from a long-term point of view, and we possibly are expecting things to improve as we go into the future. But somehow, somewhere, something is missing in terms of business strategy, products, platform, services that they offer. Having said that, IT overall, the sector has been going through a lot of challenge, not only this time, but even in the last financial year, Stacey, if you go to see, a lot of people have been underweight on IT. But if you don't look at the near-term headwinds, and if you look at a little bit stretched out time horizon of maybe about year and a half plus, then I think things should improve for IT sector companies. Coming to the guidance and the business commentary, well, most of the IT companies, the management give a very cautious or a conservative guidance, and they don't want to jump the gun. So if they over deliver, well, that's taken with both the hands. But if they give you a guidance which is a little bit on the higher side, and if they underachieve, then the markets definitely punish them. So no surprises, I think more or less in line. In some cases, in some pointers for Wipro, the numbers that unfolded, there has been a slight bit of disappointment, but let's see what the press conference is all about and what the guidance is all about.
Right, Neera, what would be your assessment, especially if you look at the EBIT margin number that coming in at 16.05 versus that 16.25, just that minimal, you could say, or marginal improvement, but how are you viewing this?
So, the IT sector itself is in a cyclical downturn. I would say that it is basically a classic episode of great companies in a bad season. So one must understand that although the results are not really fascinating, no one was really expecting it to be as much. So this is a cyclical downturn, and IT companies are exhibiting what most of the analysts on the street were already expecting. Most IT companies are very sensitive to discretionary spendings, and is also vulnerable to spillover risk from global development. We know there is a softening demand in the macro environment, and we know that it will take some time for the growth to really come back. In fact, one could go to the extent to roughly peg the current fiscal to be dedicated towards growth normalization and moderation while they get their house in order, and dedicate the next fiscal to further more aggressive growth as the appetite to spend and discretionary spending really kicks in, especially in the advanced economies, and which also comprises of most of the clients of the larger IT companies that are listed domestically. So if you look at the margins, one can expect the margins to remain under pressure. I'd say that there's still some more difficulty that IT companies will have to endure before they see the sunrise back again. So there's going to be a storm before they start sailing onto the smoother, on the smoother waves. So meanwhile, the most amazing thing about these companies is, they are really living by the fact that your routine during downtime defines how glorious your uptime will look, and the companies are really focusing on bulking up their capabilities and future proofing their businesses. So we know that the order books are filling in, the pipelines are robust, they are bulking up capabilities, so they are actually future ready, and they are willing on to take growth opportunities within their stride much more aggressively. So I feel it is a tougher today only for a better tomorrow, and the margin contraction is majorly, if you take for example, if you talk about TCS, one major component that margin shrinkage is attributable to is the wage hike. So which is in fact a good thing. It's yesteryear's buzzword, but attrition was something that everyone was worried about. But now the attrition evil is out of the picture. Attrition has come under control, and there is wage rate hikes. Although the hiring has softened, but there are wage rate hikes, which essentially means that there's a lot of focus on upskilling internal talent, and ensuring internal promotions and internal skilling is focused upon. So this is a good sign. So while there is margin contraction in the shorter term, the nature of margin contraction indicates towards preparation for a brighter future. So this is one anecdote, but I feel that this is indicative and applicable on a larger scale, with obviously distinct nuances across companies.
And one commentary or one common theme that we're seeing from these IT companies is their focus now shifting towards AI. And in fact, Wipro just this morning has also gone ahead and announced that $1 billion worth of investment over 3 years that they are looking into. Yesterday in TCS's commentary also we kept hearing about the different ways that they are going to look at it. But if you look at the overall pictures, we spoke about there could be macro headwinds, and which is why discretionary spends would come down. Is that something where, is that something that is already factored in, Gaurang? Do you think IT companies are already, the investors are already counting that in, saying that this is going to happen, so we shouldn't? And where does this whole spending on AI really feature in all of this, and how much is the focus really on that?
So, Steffi, I think change, if any, is more towards the IT environment overall, if you go to see. And in the IT universe itself, the changes happened quite fast. AI is, I believe, and I hope I'm not wrong on that, that we are at the nasal stage of AI. And I'm sure that as we go forward from here on, companies will definitely place themselves to take advantage of this, because these are the signs of how changes are happening around the world. And more importantly, I think with the kind of IT environment that we have and the kind of issues that we are dealing with right now, most of the companies, whether you are a small, medium, or a large scale company, or whether you are an MNC, you definitely want to keep your IT environment safe and protected so that the users feel confident of using those environment and platforms. Over there also, I think definitely, services and platforms of IT company will definitely come into effect. But AI, let me say this, one needs to be very prudent in terms of how we approach AI, because if it's a blessing, it can be a curse as well.
Right. Can we look at this, the constant currency figure? At least that is something really alarming, and our viewers would like to know that the constant currency number on a Q-on-Q basis has come at minus 2.8%. So that's quite a bit of slip, because in the last quarter they recorded about a 0.60%. So that number is going to be interesting to watch out for, and what will be the reasons that they're giving for this decline. But let me also get in Gaurang's view now on attrition. That has always been a pain point for IT companies, and especially, you know, in this, at least in that 2021-22, we saw a lot of competition coming in from be it startups or those getting into Web3 and all of those, and everyone was fighting for that. Now you have a whole different set happening with AI into the picture, but the talent pool, really, it pretty much remains the same from where these people are taking this kind of talent. And if you have to look at that headcount number, that one being quite a drastic drop. So is this going to be a trend that we're going to see? TCS obviously has refuted it yesterday. They said they're going to go ahead and abide by all the offers given, but Wipro already saying that perhaps not so much. It will have to depend on each project by project. So is this going to be something that is going to be a pain point, especially for the IT sector?
Well, it all depends upon what talent pool you get, and definitely India, there is no dearth of that. Let me say this, Steffi, and I hope I'm not wrong on that front. What I also, dissected into the fine prints or the verbatim that was given out by TCS, HCL Tech, as well as whatever commentary from Wipro, none of these companies are rushing to fill in the vacuum. That's a huge positive. So I think it will be a step by step, because AI is still evolving. And I don't think any company can afford to go in a big way and then possibly have a disappointment. So let's scale it up step by step and then take it.
Okay, I want to pinpoint now. We will be listening to the management commentary shortly, but let's look at the stock. I know, Gaurang, you did mention it right at the start when we started this conversation, but Wipro today ending a bit higher, you could say marginally, but on a year-to-day basis been quite flat, right? So quite an underperformer, one would say, on the Nifty. But if you look at trends that are suggesting, especially post their earnings, how they've fed, they've more or less on 7 or more occasions, the past 12 quarters, they have been quite positive. Do you think today's earnings were good enough that the street would give it a thumbs up? Nirav, you could take that first, and then maybe we'll get Gaurang's take on it as well.
Yeah, so the results are definitely nothing, anything to write home about, but however, the street was anyways dismissive about any positive expectations, and that reflected in the flattish kind of growth that you spoke about in the past couple of quarters. Going ahead, one can expect, more and more buying interest to develop in the segment, and especially in Wipro also, because there are a few business specific tailwinds that could specifically help Wipro grow ahead from where it is already. I feel although the results were slightly dismal, what lies ahead is far more exciting than what has already passed by, and the results that have come out has already been largely priced in.
We have the management, the Wipro management that is addressing media. Let's listen into what they have to say about their earnings. Thierry Delaporte, the CEO, they're addressing the media.
Closed large deals to the tune of $1.2 billion, which is a 9% year-on-year growth and the highest bookings in 8 quarters. We booked 10 deals in the greater than $30 million TCV range. Total bookings from a TCV standpoint stands at $3.7 billion. Looking at it, we added 2 more new accounts in the greater than $100 million revenue bucket, taking the count of businesses that contributes more than $100 million of revenue per year to 21. So the number of $100 million account has more than doubled from 10 to 21 in the last 2.5 years since we started on this transformation. Now, all around us, in almost every industry, businesses have been reducing discretionary spends in response to the weaker macro environment. That's had an impact on our revenue as well. In constant currency terms, Q1 revenue grew 1.1% year-on-year. This translates into a growth of 6.1% year-on-year in rupee terms. That is very much within the previously guided range, but yes, we are seeing some softness in revenues. Despite that, we have held margins steady. Operating margins for the first quarter was 16%. This is, to be precise, 112 basis points higher than our operating margin in the first quarter of last year. We maintained margins by improving productivity in our fixed price projects, a better utilization of talent, and by managing our fixed cost. At the same time, we continued to invest in people and technology to build a more agile and efficient organization. This margin resiliency is especially significant. Wipro has undertaken one of the largest enterprise-wide transformations in the industry starting November 2020. And we are proud of the progress we've made since. The success of this transformation becomes clearer when you consider the magnitude of this change. And when you see that we have continued to perform while we continue to transform. On one end, we were aligning to market needs, and on the other, undergoing a deep internal transformation. Our focus on accelerating the transformation, along with maintaining undivided attention on client experience, on delivery excellence, will progressively translate into improved growth and margins. We recorded an 11.5% growth in earnings per share year-on-year. Cash flow has remained strong. Cash conversion was at 130% of net income. And finally, this quarter, we closed our largest ever buyback, allowing us to return $1.5 billion to our shareholders. Now, our industry, like every other, is undergoing a seismic shift with the advancement of artificial intelligence. AI can and will fundamentally change every aspect of business. Anticipating this revolution, Wipro had started investing and building AI capabilities over a decade ago. We have delivered over 2,000 global AI engagement during this time. In fact, today, we are using generative AI for multiple use cases like enterprise knowledge mining, virtual assistants, content optimization, automation in software development, and for synthetic data generation as well. But to accelerate innovations in this space, yesterday, we announced a $1 billion investment in AI and launched a new AI-first innovation ecosystem, Wipro AI 360. This ecosystem will bring together Wipro's full range of capabilities, including solutions, services, platforms, research, and intellectual property, as well as partnerships and talent under one umbrella, with additional funding and resources to fuel our growth in this area. As you see, we are placing responsible AI operations at the heart of all our AI work. Wipro AI 360 is meant to empower our talent pool and be ubiquitous across all our operations and processes and our solutioning for clients. This AI-first approach will unlock more value, more productivity, and commercial opportunities for us and our clients. But first, we need to train our people in this fast-moving field. Over the next 12 months, we will train our entire workforce, nearly 250,000 employees in AI, from hackathons to challenges on our talent crowd platform, Top Coder, to specialized trainings. We will leverage our blockchain-based DICE ID platform to become the industry standard for AI skills credentialing. Demand for AI specialized talent will grow exponentially over the coming years. We know that, and we will be prepared. Suba, our Chief Technology Officer, is here with us today to share more. Let me now talk through our strategic market unit performance, as in every quarter when we meet. In Americas 1, order bookings in terms of total contract value grew 37% year-on-year. Revenues for the quarter grew 1.5% year-on-year in constant currency terms. This revenue growth was led by healthcare and medical device at 9%, followed by consumer goods and life sciences at 7% each. High-tech, BFSI, are the two sectors that were impacted the most during this quarter due to softer discretionary spends. As a result, our Americas 2 market declined 2.7% year-on-year in Q1. In Europe, our European business unit delivered a year-on-year revenue growth of 4% in Q1. This revenue growth was led by Southern Europe and Nordics, which grew 26% and 14% respectively in the first quarter. In our APMEA business now, bookings in total contract value terms are looking healthy, with a 23% quarter-on-quarter growth. Revenues for the quarter grew at 3% year-on-year. Within this SMU, our India business grew 7%, and our business in the Middle East grew 6.4% year-on-year. In Q1, we completed the transition to the 4 global business line model that we had announced, if you remember, in the last quarter. This evolution of our business model is already showing up as faster time to market and also more inclusive one Wipro customer and delivery wins. Whatever challenges our clients may have, the solution exists within our global ecosystem, and we are tapping into the talent, capabilities, and solutions from every corner of our firm. We're increasingly able to build bespoke solutions for clients, and that's what is setting us apart. Ultimately, our focus is, and always will be, on serving our clients with greater innovation, attention to detail, and excellence. A great example of this is our recent win with a global digital interactive entertainment leader. Wipro will modernize their network infrastructure, delivering improved responsiveness and user experience. We will drive scalability to handle increased workloads and reinforce end-user security, all the while creating a platform that supports the client's expansion plans. This project brings together Wipro's architectures, consulting, cloud migration, implementation, and managed services capabilities. This win is also a good example of how Wipro can bundle solutions from multiple partners to deliver a wide range of capabilities. In terms of the demand environment, in some ways we are seeing tech investment normalize after the sharp acceleration in spending during the second half of the pandemic. More and more, clients are expecting faster returns on investments and optimizing cost through increased use of automation and vendor consolidation. In parallel, we continue to see solid demand in high growth areas like cloud, mostly around cloud transformation. Clients are seeking out Wipro's full stride cloud capabilities for the next phase of their cloud strategy. We are helping them run more efficient and agile businesses and capitalize on the emerging opportunities presented by artificial intelligence. For example, a large global medical device and healthcare company has selected Wipro to transform their operations infrastructure into a modern, cost-effective, and cloud-first model. Wipro FullStride Cloud will deliver a consistent and omnichannel workplace experience to 120,000 employees in 160 countries. We will help this client achieve 40% automation and cost optimization, this while simplifying their global operations. Now, we are able to do all of this and more thanks to our 250,000 associates around the world. We want to see them succeed in their roles and in their career. As part of our transformation, we've continued to work on various aspects of employee experience with several new initiatives to streamline policies, processes, talent support, training, development opportunities. And we also want to make sure employees' voices and concerns are heard. Our 2023 employee engagement survey showed an overall engagement score of 88%, which is higher than ever before. And now, benchmark us to global standards on employee experience. Very proud of that. We were also named one of India's best companies to work for by the Great Place to Work Institute for the second year in a row. But that, to me, is table stakes. We must, and we will, continue to improve how Wipro is experienced by our employees. Because of all these efforts, attrition has continued to moderate quarter on quarter, coming in at an 8-quarter low of 14% in the first quarter. I am very confident that our long-term business strategy is correct and well suited to ride the changes we predict in the industry. Most importantly, I believe our business strategy will keep us competitive and resilient in the future. A final word here on our guidance before I close. For the next quarter, we are guiding for a sequential growth of -2% to +1% in constant currency terms. We expect margins to be in a similar range as in the last few quarters. With that, let me turn it over to Jatin now for his comments. Thank you.
Thank you, Thierry. Good evening, ladies and gentlemen. As you know, we grew this quarter 6% year on year, and we expanded margin compared to 15% we had in quarter one of last year to 16% this year, which was 14% growth of operating profit. Our other income was higher at 110%. Our tax rate was slightly higher as some of our SEs had come out of the tax bracket. It was at 24%. And as a result, our net income grew 12% year on year, which I think was a very healthy double-digit growth of profitability or profits year on year. Let me talk about cash flows. We continue to convert our profit very well into cash. Our operating cash flow as percentage of net income was 130%, and free cash flow was 126%. And again, both measures you would appreciate as one of the strongest that you could wish for. On Forex, we realized a healthy realization of 81.90 for every dollar that we earned. And we had $3.6 billion of hedges at the end of the quarter. In terms of cash, as all of you know and Thierry spoke about, we completed our largest buyback ever. And after that, we still have a lot of flexibility on balance sheet. Gross of debt, we are at $3.5 billion of cash on the balance sheet. And net of debt, it is $1.7 billion of cash on the balance sheet. So therefore, it leaves all the options with us in terms of how we prioritize our strategies as an organization. So this was a brief color on financials, and we'll be very happy to take your questions from here.
Thank you, Jatin. We will start the Q&A session. Please, if you have a question, raise your hand and wait for the microphone to be passed to you. We ask that you please limit your questions to 2 to start so we can give everyone a chance to ask a question. If we have additional time at the end, we'll be sure to circle back to those who still have questions. So let's kick off our Q&A.
Hi, I'm Ritu from CNBC TV 18. First, I wanted to get in a sense of what the second half looks like. You've given us this constant currency revenue guidance of -2 to 1%, which is perhaps, 2 to 1%, which is slightly better than what the street was expecting. But when do you see a more meaningful recovery, especially in BFSI and consumer, which are 2 of your largest segments, still seeing a significant amount of weakness? One, that. 2, for the last 3 consecutive quarters, we've been seeing a decline in the headcount. A net decline of almost 8,800 in this quarter. Is that unusual, even though the attrition rate, I understand, has been coming down? And what are your hiring plans for the year? And if I may add, this large investment that you've announced of $1 billion in AI, when do you start to see that yielding results in terms of better revenues? Thank you.
All right, so thank you for the question. I'll try to remember the 3 questions or the 4 questions I'll take, and when I'll give maybe one to Saurabh and to Jatin. So the first one is, your question is around, outlook for the second half. And to be honest, I think it's too early to tell. I think, by definition, we are, as I have said for the last 2 quarters, we are in a time of uncertainty. And therefore, companies are not necessarily very forward-looking in terms of, how much they're going to spend in 1, 2, 3, 4, 5 months from now. What we are observing is that there's a ton of programs going on, and that's why we are, doing another solid quarter in terms of bookings. But there's also a lot of smaller discretionary spend that have been maybe postponed or stopped. And I think, when will this resume in the sectors in particular that you mentioned? Too early to tell. I like to be talking about what I'm seeing, and I would say for the time being, I continue to see more or less the same market that, the one we saw a quarter ago. So that's on the first question. On the second question, which is around headcount evolution. You probably remember, actually, I mentioned we have done some organizational changes in creating 4 GBL. And that has, met 2 key objectives. One, that is to get us closer to our clients and be able to drive more comprehensive end-to-end transformational solutions for them, and at the same time be more agile and more nimble. And I think, as a result of that, we've been able to streamline our operations, reduce the number of overheads, just remove some of the layers of unproductivity that we had. So you should look at this, for sure, I would say the kind of muted growth that we are seeing is not driving necessarily the need for more headcount, but I think some of those adjustments are more coming from the fact that we are more agile and more efficient as an organization. Jatin, question about AI. On the AI, investments are starting now. I mean, we are literally on it. We've invested for the last years, but we are now accelerating. And so investments are starting now. A significant part, the biggest part of those investments are organic. So it's, investment that we are driving already now. I believe this month, as you know, we have shared this, we are going to train 100% of our employees, starting this month. And so those investments are actually engaged now. So when we look at the $1 billion, it's more or less, based on the assumptions of a steady acceleration of the investment.
Your question about when will it translate into revenue, it is already translating into revenue. We already have, as we speak today, dozens of programs around AI and generative AI, and there's an increased demand. For sure, there's an increased demand from clients. We will probably see an evolution of the type of size and deals of the deals we are seeing in that space, for sure. But we are already seeing a significant increase of our volume of business in that space. Hiring plan, Saurabh, for you.
Thanks, Thierry. So, hiring is based on the macro environment, the demand, and we will continue to hire in critical areas. We're seeing a big investment in AI, data, security, engineering. We'll see continued hiring in this, specialist skills as we move forward. So that's how we'll look at hiring, and we'll calibrate it every quarter depending on the demand environment. We don't give number that,
Of course, please.
One, I was looking at your growth metrics across both your geographies as well as sectors. Geographies in reported terms has fallen in all of them, and BFSI is seeing the worst impact. Just want to understand what the trend will be like going forward on this front. Also, on the consulting business, you've obviously invested quite a bit in Capco and Rising, and you've also repeatedly spoken about how discretionary spend is coming down. So I just want to understand what the outlook is like for those businesses. In terms of fresh, I just want to get two updates. One on fresher onboarding, what the numbers are like, and what the variable pay will be like.
Next Gen Associates.
Next Gen
How we call
Associates,
that.
yes.
All right, so the first question is the growth per industries, right? So if you look at industries and then by geography, by industries, where we see a slowdown in terms of discretionary spend and therefore in terms of growth overall, it is BFSI, technology, communications, primarily those sectors. Other sectors like healthcare, like energy utilities are actually doing well, okay? From a market standpoint, Americas has certainly been the place where we have seen the slowdown the first. And I think Europe has been holding pretty well for us. There might be, some slowdown in discretionary spend in the sectors that I've mentioned in Europe as well. But, I find that Europe is rather resilient as a market. And as you can see from our performance in Americas 1, there's some nice, positive trends as well in some of the industries. Your third question was around Next Gen Associates, the growth for the year. Oh, Capco Consulting, sorry. When we've made those acquisitions, whether it's Capco, whether it's Rising, whether it's Agile, it is because we know that in order to have the opportunity to be a transformation partner for our clients in, key areas of addressing their business challenges, the consulting expertise is critical. And so we've made those investments, and they were absolutely strategic. And they are today more than ever. So we've made those acquisitions completely consciously, knowing that the consulting business is by definition a business that is growing fast in a growth market and slowing down the first in a slowing down market. And that's what we've observed over the last quarter. It doesn't change a thing about, the value of the strategic value and the strategic nature of those acquisitions. Well, what we are seeing now is that indeed they are more exposed in terms of discretionary spend than some of our other service line, yes. Saurabh, you want to go?
So on two questions are here. One of them NGAs and Excel. So we will again calibrate based on demand. Today we have capacity, we have existing NGAs. So we will continue to onboard them basis the demand environment. That's what we go for. Numbers we won't give because as it is an environment, as you know, as Thierry called it out, it is uncertain.
Last year was the highest year in
ever
terms
we
of
had.
NG
In
onboarding.
Q1 we didn't onboard. Q1 we didn't onboard because we had very lots. Q1 we didn't onboard.
I think it's typically a year where you have to stay agile. And I think there's no value in giving a big number for a year when you know that, we are observing how some of the trends are going to evolve over the next quarters.
Yeah. And as you heard Thierry speak about, what we have heard from our employees and employee experience and focus on that area, given the tough environment also, we will continue to do things which are important. And so our promotion cycle continues every quarter, which we did in Q1, we'll do in Q2. Our variable payout will be around 80% in Q1. So that is in spite of this environment. So we will continue to do what is required for our employees. So that one, but continue to calibrate with the business requirement.
Hi, gentlemen. 2 questions. First question, sir, on the growth. Your growth this quarter is a little soft. And this is not just about this quarter. Even if we look back, say, over the last 5 quarters, in 4 of the last 5 quarters, you've struggled to grow more than 1% sequentially. And the outlook also is again a little soft. Strategic units and sectors is looking a little weak. What I want to understand is that in your 3 years here at Wipro, how much of this is because of a macroeconomic and how much is it related to, say, a company's specific problems, which you perhaps have still not been able to resolve? I'll really appreciate if there can be a qualitative remark
For sure.
with regards to that. That's the first broad question.
Okay.
The second is when you said that in the immediate term, the margins would be close to what it has been in the last few quarters. 16% is the margin which has been the band for the last 3 or 4 quarters. It's not really gone up beyond 16. Now with vendor consolidation, cost takeout deals, do you believe a new normal for Wipro for the margins would be around this 15 or 16? I don't want an answer with a specific, but would that be the new normal?
I'll take the two answer. You correct me if you. Okay. So on term, look, in terms of growth, this is always, I find a little bit the danger of looking at an evolution of a business just based on a quarter. Look at Wipro over the last 3 years. 45% growth between 2020 and 22. Calendar year, end of 22, actually fiscal year 23. 45%. So can we grow? Of course we can grow. And we've grown more than ever before. So to your first question, of course we can grow. The reality is, and I have always said it, when I have started to observe it, is there has been a bit of a slowdown. Is it completely abnormal? After 2 years of growth, 45%, I repeat, 100,000 people net increase in the organization. Is it surprising that after there's a bit of adjustment? I don't think it's an issue at all. I think, yes, you're right. The growth is not the same now, obviously, and the market is what it is, but it doesn't change a few things. One, that, as soon as the growth is, there is demand in the market, we are on it. Second, we are growing in every strategic key areas. Third, in terms of bookings, we win against anybody in terms of, competitive landscape. So, and final, even if you want qualitative, I can tell you the market focus of the leadership team is complete, is total. Okay, so that is not a concern at all from an ability to grow as an organization. In terms of margin, we have reported 16%, and yes, we've been at this level for the last 2-3 quarters. We don't think we will go below. Okay? So, this is, we feel that, and I've said it also, we know that as we continue to work on our fundamentals, we will be able to gradually improve the margin. That's how we look at it.
Wage hike later this year, and you are saying you will not go below 16%?
That's what I've said.
You're right, yeah.
Hi, gentlemen. This is Sai Ishwar from the Economic Times. I just wanted clarity on your guidance. You've guided -2 to +1%, but the deal wins you've won over the past few quarters, it's been over $3 billion, like consistently for the last 3 quarters. So, can you tell us, like, what are the downside risks you're seeing? Is this project ramp downs, or do you see macro or anything getting worse? And also, I wanted one clarification on the total number of active customers has been quite falling, even on sequential basis, it's down 35%. So, is the new organization structure
Down
kind
35%? No.
35 customers?
Okay. So,
Sorry. So, is the new organization structure, is the reason behind this?
Yes, there is. Okay, so let me take the second question and then I'll come back to the first one. Second question, yes, there is a reason. It's a conscious choice. It's a strategic choice. We want to focus on, key clients and invest in the relationship long term. And so we prefer to reduce the tail of account and really develop meaningful relationship, partnership with these clients and grow those relations. So that's why, you probably see that. On your first point, which is, around...
Downside risks. Downside risks to the guidance.
Well, so we've guided -2 to 1. You notice that this is, a little bit wider range than what we've given the previous quarter, because precisely, we know that we are in a market that could evolve, in a way or another. We are telling you that what we see right now is, within this range. And that's a combination, and that's what probably makes it sometimes not easy to fully understand, is on one end, if you look at the volume of bookings, so the type of deals that we close, there's more than before. And you're absolutely right. 3.7 billion this time. Over the last 2 quarters, very strong as well. We are closing more large deals than we used to close before. But at the same time, reduction in discretionary spend, smaller engagements, for 1 quarter, for two. Do we have a large program ending? No. Do we have relationship stopped? No. Have we lost a client? No. This is really more, frankly, it's really more a direct consequence of, the spending pattern of our clients at the moment.
Which are the sectors you're seeing the ramp downs or the spending cuts?
Banking, financial services, technology, communications.
So, I just want to add a little bit of numerical color to the question which Thierry responded to. You are right. We reduced active customers from 1479 to 1444, which is the 35 number you spoke about. But we also added 65 new customers. So if you take 65 and then you take that 35 reduction, 35 reduction, you will see 120. So we reduced the tail by 120 in the quarter 1, but we added a $20 million customer base. The customers which are larger customers, 117 to 123, we added 6 more customers. At $100 million, we added 2 more customers. So strategically, we are pivoting our business from doing more value-added work for more strategic customers than doing sort of tiny amount of work for a small customer. So that's the shift that the organization is going towards.
Okay, good evening. So you spoke about Gen AI. and it's a very promising technology ahead of us. So you also said it will be organic growth. So somewhere in the future, are you looking at acquisition in this space? And second thing, how many clients you're working with in this space, Gen AI?
On the second question, several dozens of clients we are working with at the moment, okay, around the world. On the first question, which is, acquisitions, yes, absolutely, we will consider that. As we've always said, and this hasn't changed, we have said that, we will focus on strategic acquisitions in areas where, there's demand for the future. We are constantly focusing on mid to long-term investments and priorities. See, our objective is to make sure, our primary obsession is to make sure that, our clients will be able to rely on us for their transformation going forward. Gen AI is key for them for the future. So for sure, whenever we identify a company that, would complement or enhance our capabilities or our positioning in this field, we will consider acquisitions.
Thank you. Hi, this is Haripya from Business Line. Just wanted to understand, is the conversion of TCV to revenue taking time? Do you see a lag there? And on Gen AI, the AI 360, have you internally completely deployed the offering yourself? And if yes, what is the kind of efficiency that you've achieved by doing so? And on the margins, given you said that it maintained the same thing. So what are the levers that would help you, given that there's pay hikes ahead?
Okay. Revenue conversion, I think I covered it. I can maybe say a few words. What you have when you look at TCVs. There's more large deals. There's less very small deals than before, and so it's what triggers the situation where at the same time we win more large deals than before, and at the same time we have less. We are suffering, if you like, from less discretionary spend with our clients. So that's point number one. On the point number two, which was AI 360, Wipro AI 360. It's an ecosystem that we've developed across the organization. It's in place. We've launched it. It's officially launched. Okay, and to give you a feel for the nature of this official launch, we have organized inside the organization an AI council that I chair and that we hold every single week with the rest of the team, so that we are driving all the priorities around AI 360 at full speed. So we are on it. The third question was,
if you look at our cost structure, I think there are inherent steps which one can take to offset some of the impacts of wage hike or any other cost increase. One is clearly the utilization, which has improved from previous quarter to this quarter, and it will continue to find more success as we move forward. Second is just a pyramid improvement as we continue to hire more and more next gen associates. And I can tell you that numerically, the next gen associates as part of our total delivery pyramid, which is serving our customer today, is significantly higher than where we were as a percentage 4 quarters back. But it is still a way to go. Third is really the automation, which we can deploy in our fixed price project. So I think these are the large levers that we will continue to operate on.
Hi, okay. My name is Naomi. So this quarter, the year-on-year revenue growth has been the slowest since March 2021. So I want to understand, will we be witnessing a slower revenue growth going forward?
Sorry, I didn't.
This quarter, the year-on-year revenue growth has been slowest since March of 2021. So I want to understand, will the revenue growth slow down going forward? And the second question I have is, what range of deals are you all expecting for the upcoming quarter?
So on the first point, as you know, we guide for the next quarter, and it's -2 to +1% growth for the next quarter. We had a question on the second half, and we said that it's too early to tell, given the, I would say, volatility of the current market. On the second question, type of deals, we have more large deals in the pipe that we had typically in the past. And so it's, we go full speed on those large deals. We have many in process.
Hi, Ayushman here from Business Standard. So yeah, just wanted to get a sense of what is the pipeline for the mega deals, the $1 billion plus deals, and also are these mega deals or the very large deals the cost transformation, or they are the cost optimization type of deals, or they are the transformation type of deals that you see?
Well, so they are deals of that size. They are at the moment ongoing, and we are working on some at the moment. I cannot be more specific, but there are deals. There's more. Typically, we have more of these deals in our pipe that we had 2 or 3 years ago. They are not necessarily only focusing on cost takeout, but certainly there is an expectation to drive productivity and efficiency. Absolutely, no doubt. I think, today the deals that, the large deals that companies are contemplating are, deals that are driving simplification, efficiency, and committed gains in terms of cost of running versus the opportunity to reinvest into new technology.
Thank you.
We'll take one more question, and
One
then
last
we'll
one.
have to wrap.
Hi, this is Rukmini from Fortune India. I want to go back to AI 360 announcement that you made a couple of days ago. It talks about, to accelerate investments in cutting-edge startups through Wipro Ventures. So out of the $1 billion that you've earmarked, is there any sort of internal budgeting on how much of that would go into acquisitions, and also some understanding around the seed accelerator program? Is this going to happen under the aegis of Wipro, the company, or ventures, those details?
Okay. So thank you for having this question on AI. Give me the opportunity to ask Subha to speak. You okay? Yeah. All right.
So I'll take the last question first, and you have to probably remind me about the other two. So the Gen AI accelerator is in addition to Wipro Ventures. We believe that Gen AI evolution is going to fundamentally shift how we do business. Not we as Wipro, but the world does business, and the world performs overall. Most innovations happen in the startup ecosystems. They're mostly trying and finding interesting problems and solving for those interesting problems. So the whole idea behind Gen AI Accelerator, we have close to 100 startups that have already applied for this program, is to help seed and pre-seed startups to scale and incorporate them into our ecosystem. With our reach of 1,400 plus customers, we are able to find interesting problems for the startups to work and continue to work on, and conversely be able to solve for interesting problems for our customers, and then enrich our AI 360 ecosystem as well. So it's truly a way of a symbiotic relationship that we are beginning to form with the startup, the innovation ecosystems, the enterprise customers, and we think that this is going to be one of the factors that will change the game for us into the future. So that's on Gen AI Accelerator. The first two questions were, you have to remind me.
You want me to take that one? So, the way we've built this plan of $1 billion is counting on, the vast majority of the investment is organic, okay? But it includes also potential acquisitions that, we would do along the way.
So does it actually accelerator can actually end up as sort of betting ground for possible acquisitions that you would make through Wipro Ventures? You know, you have good.
Yes. It's not the only way we're looking at it. Yes.
Today, if you look at Wipro Ventures, about a two-thirds of the companies that we have inside this, venture fund are AI companies. So we have great foundation already. Doesn't mean we will not continue.
It gives a very, very solid ground for us to create both investments, partnerships, scale, and also our own R&D efforts.
Well, gentlemen, this concludes our first quarter fiscal 24 press conference. Thank you all so much for joining us today. If you have any additional questions, please feel free to reach out to me, and our media relations team will be happy to assist you and respond to your questions. And we will see you next quarter.
Thank you.